Welcome to this explainer. Okay, today we are embarking on a seriously fascinating journey. We're tracking the complete evolution of digital assets, starting all the way back at the cypherpunk origins of digital money, right through to the incredibly practical steps of evaluating your very first tokenized investment. If you've been watching the markets lately, you know that the way we define, share, and trade ownership is undergoing a massive, fundamental transformation. We're moving from a world of rigid, hard-to-move assets into a highly fluid digital token economy. It's a game changer. Let's get right into it.
But to really get why digital tokens matter so much, we first have to understand why traditional currency can completely fall apart. Take a look at this incredibly visceral memory from entrepreneur Wences Casares. Growing up in Argentina back in 1984, hyperinflation was so severe, so out of control, that his mother's cash salary would literally lose purchasing power by the minute. They had to sprint through grocery aisles to outrun the store clerk who was constantly marking up prices. It's an intense story, right? But it reminds us that relying on centralized traditional currency isn't just some boring economic theory. When it fails, it is an absolute crisis of survival.
Okay, let's dive into this. Here is our roadmap for today's explainer. We're going to cover the flaws of traditional money, Bitcoin as a digital lifeboat, the rise of tokenization, how fractional ownership is unlocked, navigating those tricky risks and regulations, and finally, exactly how to research tokens for yourself.
Section 1. Flaws of traditional money, the consequences of financial privilege and hyperinflation.
And this brilliantly illustrates the core economic argument behind the entire digital asset revolution. Think about unsound money. That's our fiat currencies controlled by central banks. Because its supply can be infinitely inflated, it quietly destroys your purchasing power over time. It essentially forces people into what economists call high-time preference behaviors. Basically, it incentivizes you to spend your cash and take on debt right now because your money's going to be worth a lot less tomorrow. But then look at sound money. Historically, this was gold, and now it's Bitcoin. It's totally decentralized and strictly supply-constrained. That preserves your purchasing power and encourages low-time preference, meaning it actually rewards long-term saving and careful investment.
Now here's a bit of a reality check for us. If you live in the US, Europe, or Japan, you have immense financial privilege. You were born into a system with a relatively stable reserve currency. According to our sources, that single fact gives you an inherent advantage over 89% of the global population. Think about that. For people in places like Cuba, Nigeria, or Argentina, escaping financial oppression and inflation isn't just some intellectual exercise, it's an urgent daily necessity. They absolutely need a system they can actually trust.
Which brings us to Section 2, Bitcoin, the digital lifeboat, establishing decentralized, sound money. So the crucial point is this specific number right here, 21 million. That is the absolute, mathematically enforced hard cap on the number of Bitcoins that can ever be created. Period. Unlike fiat money, there is no government or central bank on Earth that can simply print more of it to pay off debts. This absolute scarcity is the literal engine that drives its value as a digital asset, making it a highly reliable store of value over time. But you might be wondering, how did the mysterious pseudonymous Satoshi Nakamoto actually pull off this unhackable decentralized ledger? Well, Satoshi didn't actually invent these underlying technologies from scratch. Instead, he brilliantly combined 4 existing tools. You have a distributed peer-to-peer network, meaning no single boss is in charge. Hashing algorithms ensure the data literally cannot be tampered with. Digital signatures using public and private keys make sure only you can spend your own money. And finally, proof-of-work mining uses raw computing power to verify an unhackable timeline of transactions, all without ever needing a bank.
Moving right along to Section 3, the rise of tokenization, building an economy on the blockchain.
To build a real economy, you need rules, you need agreements. In the blockchain world, these are known as smart contracts. Now, don't let the name confuse you. They aren't conscious legal documents. They're just conditional transactions written in code. Think of it as simple if this, then that logic. For example, if a flight is delayed by 2 hours, then automatically refund the passenger's digital wallet. Bam! No middlemen, no waiting on hold with customer service. Smart contracts are the crucial foundational bridge that makes all modern tokenization possible.
To really understand how these tokens exist, think of it exactly like your smartphone. The Ethereum network acts as the base operating system, kind of like iOS or Android. It's fueled by a crypto commodity called Ether, which basically pays for the raw computing power. Then, on the flip side, we have crypto tokens. These are like the individual apps you download from the App Store. They're built on top of that Ethereum operating system. So most tokens you hear about, they don't build their own blockchain from scratch. They just utilize existing, massively secure networks like Ethereum to run their smart contracts.
Section 4, Fractional Ownership Unlocked. Democratizing access to illiquid assets.
Now, what's really interesting about this slide is how wealth democratization actually works in practice. Picture a $100 million commercial skyscraper, or maybe a priceless piece of Renaissance art. Historically, only the ultra-wealthy or massive hedge funds could ever dream of investing in these illiquid assets. But through tokenization, that single massive asset is legally and digitally sliced into thousands of liquid, easily tradable tokens. You, as a regular retail investor, could own 20%, or literally just a fraction of a single percent of that building, and you can trade that token on a global market 24 hours a day, 7 days a week. The benefits here are just staggering. First off, it completely shatters the barrier to entry for gated assets. It massively increases global liquidity, meaning you can sell your share of a skyscraper almost as easily as you'd sell a stock. And remember those smart contracts we talked about? They mean things like monthly rent checks or art royalties are automatically, instantly distributed directly to the token holders' wallets. Plus, the blockchain provides a totally transparent, unforgeable history of ownership. We're drastically reducing our reliance on expensive middlemen like brokers, lawyers, and clearinghouses.
Section 5, Navigating Risks and Regulations. Avoiding the pitfalls of the crypto Wild West.
Now we have to ground this excitement a bit. When assessing crypto markets, you absolutely must realize that financial history repeats itself over and over. Back in 1637, we had the Dutch tulip mania crash driven by mass speculation. In 1929, the stock market crashed due to mass hysteria and structurally rigged systems. In 2008, the mortgage meltdown forced incredibly heavy banking regulations. Fast forward to today, and the crypto space is experiencing its very own Wild West phase. It is packed with people falling victim to the greater idiot theory. You know, buying a totally worthless token simply because they assume some greater idiot will happily buy it from them at a higher price later on. Don't be that person.
Let's move to and see how this builds our current regulatory landscape. When government regulators look at tokens, they generally toss them into two buckets. First up, utility tokens. These are designed purely for infrastructural use, like digital fuel meant to run a specific application. Generally, they face less regulatory friction. But then we have security tokens. These represent real ownership in traditional assets, just like that real estate example we used earlier. Government agencies heavily monitor these, viewing them squarely through the lens of traditional finance law. Essentially, if a token promises a return on your investment based solely on the work of others, the SEC is absolutely going to regulate it.
Another huge technical risk for new investors is this concept of thin order books. Basically, if a new or small crypto token doesn't have a lot of trading volume, meaning the market is highly illiquid, it becomes incredibly vulnerable. A bad actor with just a little bit of capital can buy up all the available orders, artificially driving the price sky high to create a ton of fake hype, and then dump all their holdings at once, completely crashing the price back to zero. It's the classic pump and dump scheme, and you have to watch out for it.
Section 6, How to Research Tokens. A Beginner's Guide to Due Diligence.
Okay, if you take absolutely nothing else away from this explainer, please follow this 4-step framework from our expert sources before you invest. Step 1, completely ignore the market hype, the madness of crowds, the FOMO, the Twitter noise. It will only lead to losses. Step 2, actually research the technical fundamentals. What does the smart contract actually do? Step 3, check their legal compliance. Is this a utility or a security, and are they playing by the rules? And finally, Step 4, analyze the market liquidity. If that order book is thin, recognize that you are looking at a prime target for manipulation and tread very carefully.
Ultimately, evaluating a token is not just about staring at a green and red financial chart all day. A truly robust, lasting token ecosystem must be evaluated across these 4 multidisciplinary pillars. Is the underlying technological infrastructure both secure and scalable? Are they legally compliant with regulators? Do the economic structures and the game theory actually align everyone's incentives fairly? And finally, from a governance perspective, how are they handling your data privacy and distributing authority across the network? I promise you, a token that fails on any of these pillars is just a house of cards waiting to fall.
Well, we've covered incredible ground today, from the historical flaws of fiat money to the amazing mechanics of fractional tokenization and the absolutely critical importance of doing your own due diligence. I want to leave you with this final provocative thought. If tokenization can slice up a massive skyscraper or a world-famous masterpiece, making it accessible for literally anyone anywhere to own, how will this completely reshape your financial future and the very concept of ownership itself? The tools are out there right now. The systems are being built as we speak, and the rest is entirely up to you to explore. Thanks so much for joining me on this explainer, and keep learning.